Okay, we're going to get started. I want to thank everybody for joining us in today's webinar. Today's topic will be financing your association's capital projects, which is a little bit of a misnomer because we're going to include a couple other things with this. So aside from capital projects, which a lot of people in condominium associations or HOAs deem as like discretionary projects, maybe new hallways, new entrance, doing a beautification, that type of thing. But we're going to also include necessary projects. And what do we mean by necessary? We mean necessary projects because of the new regulations that have been promulgated by the legislature over the last couple of years and which are now undergoing some revision. But it's going to be having to do with also funding your association's needs when it comes to meeting work required by a milestone inspection or work required because of the Sears component. So we're going to wrap that all into the lending aspect of it. So welcome again. Today's panelists for our webinar are Reginald Breton. Reginald is our cash management strategist here at AKAM. And we're also joined by Rebecca Prieto, who is Senior Vice President at Popular Association Banking. Popular being one of the preeminent lenders, if not the biggest lender here in South Florida, to associations concerning loans and lines of credit. So as I said, as an introduction, we're basically going to be talking about those two kinds of projects, discretionary as well as mandatory. And why do associations need funding? Well, let me approach it with the fact that with the new regulations, particularly with the Sears and also the milestone, there are going to be requirements where before, you could do reserve fund over a period of time, or you could do assessments. But because of these projects, now you're talking about increased dollar amounts and increased timeframes and sense of urgency, depending upon if you're also under, say, a municipal order of some sort to complete work or what have you. So what I'd like to do is just start with the process. And what we do is, and here at AKAM, where I'm going to first let Reginald describe, when we have a management client who is in need of potential financing, they come to Reggie. And Reggie will take the bull by the horns, so to speak, and start to discuss what their needs are. So Reg, if you could kind of come in and just tell the people on the group on the webinar what it is, the type of questions you ask, what you need to be able to go out to someone like Rebecca and start the process.
Hi, Doug. How are you? Thank you, everybody, for joining. Thanks for the introduction, Doug. Initially, my first question is really what is needed right now, what is required for the association. And probably the biggest concern now is that we've seen is the increase in interest rates over the last 2 years. And no longer the association is looking to just do one project here, one project there. They're looking to, and with the upcoming regulations at the end of the year, they're looking to really put everything together because all the work that is needed to be done has to be done immediately. So the first and foremost I asked them is, do they have any bids? Have they spoken to any engineers, and if they have any estimates for the upcoming project? If they do, we take those estimates together, and then I request financials from the association. I gather those financials, discuss their options as far as terms for financing for the loan, and explain to them the products that the banks have available, and most importantly, how the terms for the financing that they're thinking of paying back the loan to the bank. Do they want to go short term, 5 years, 10 years, 15 years? Obviously, when it's a larger project, as so many of these projects have become, it's really only feasible to finance over a longer period of time. keep the payments low. But once we have some sort of outline of a determination of what the terms are going to be as far as paying the loan back to the bank, we have the bids from the engineers. We put all that information together with 3 years of financials, and then we present it to the banks for financing, such as Popular Bank, and then from there we put together an initial term sheet, which is an indication by the bank that shows their interest in the loan, and after that they've reviewed the initial financials to see if the association is in a good position to borrow the funds to complete the project and also to pay back the loans. And then
Great. So I
and then
think that's, you getting that process started is the first
correct.
thing to do. So, and I am remiss, should any of our viewers want to ask a question, we will have a Q&A period at the end of the webinar. And if you would like, you can put your question in the Q&A button at the bottom of your screen, and then we'll direct that when we have the Q&A. So Rebecca, Reggie calls you up and says, Rebecca, I have a building, they need money. You want to take it from there and tell me what you guys do and how you do it?
So Reggie calls me and says, I need a term sheet as of yesterday. The association, I have this association that's looking for X with a line of credit over this period to convert to a term loan. I ask them for the purpose, and there's a set of questions that I ask them, which pretty much is on the data sheet or the application. Then he gathers those financials. There's a few financials that I like to have prior to issuing a term sheet, such as the budget, the operating budget, the project budget, the interim, the year end, and the delinquency. Because with those financials, I'm going to know the credit risk of the association, which is a factor in determining the interest rates. And we lock the rates up front for both the line and the term. So once we have those 5 preliminary documents, we go ahead and issue a term sheet. Once Reggie has been able to provide that information to the board feels comfortable in working with us, then he would go ahead and provide us the financials, a package, which is a listing of documents, financial documentation that we would need listed on the application. He would send it to us. We would prepare it, make sure that we have everything in place prior to submitting it to credit. Once we submit to credit, it can take from 5 to 10 or 15 business days to get a credit decision, depending on the number of loans that we have on the list to review. Then once the credit is approved, we go ahead and prepare a commitment letter. The commitment letter is sent to Reggie or to the board, depending on who we are dealing directly with. And then they have X number of days to go over it with their management, their attorney. And then once they're ready to proceed with us, they'll go ahead and sign the commitment letter, send it in with the commitment fee. We take that letter, we transmit it to Banks Counsel, who will be working with the association's counsel for the review of documentation and for the rendering of the opinion letter. And from there, we go ahead and we close the loan. That's how it works.
Great. So you've outlined the process. Let's delve into it a little further, because you mentioned a couple of terms I just want to bring out and go through those. Because you mentioned, and one of the things is, how are these financing vehicles structured? And you brought up a very good way to do that, which is the line of credit, and then also in a lot of these type of projects where the board would come to you or the association would come to you for a line of credit, and then that would morph into a conventional product, depending on what type of project, construction schedule. If you could describe a little bit about that line of credit, what type of projects would your lending be eligible for, that type of thing?
So what we do is we look at the purposes of the projects that are going to be funded. We look at the useful life of these projects. We also ask the associations, how long would it take from beginning to end to complete these projects? Because the best way to structure it would be a line of credit for during the construction period. We try to keep it within 12, 18, 24, and if needed, 36 months. But remember that we lock the rates for you on the term loans upfront, not understanding how much you're going to use. So it's best if you don't go all the way to 36 months because the rate would be better. Remember, we're locking the rate 12 months in advance, 24 months in advance, 18 or 24 or 36 months. The longer on the line of credit, the higher the rate on the term loan could be. One of the good things about our financing is if you take the line for 12 or 18 or 24 or 36, at the end of the line of credit period, you don't lose on the availability, even if you haven't completed your job, even if you're not ready to pay the vendor. Those monies will be available to you. Let's say that at the end of the 24-month period, the construction is not completed. The board will not lose on the availability under the line. At that point, you will draw everything that's needed. These funds are placed into an account under the name of the association with a hold placed on this account. And instead of drawing from the line, you're actually requesting to release these funds from your account. Yes, you'll have to pay principal and interest monthly and the full amount that you draw. But this is the way that it was structured to help you with the interest rate on the loan, to lock the rate. That's the process. And we can do lines of credits for how many months you need to convert to term. We do 5, 7, 10, 15, 20. We've done 25, and we have one 30-year loan on the books. I've been with the bank for 23 years, and this is all that I've done for the last 25 years to provide financing to community associations. We will structure the loan according to the association's needs. We could also structure it as a term loan where all the money is out. We are working on a process to see if we can even provide much better interest rates when you take a term loan than when you do a line to term. We're in the process of that.
So that
anything else, Doug, that I can answer?
Right, that vehicle would be where, let's say an association needed a $10 million vehicle, that they would be able to necessarily get a better rate if they just took it as a conventional term loan from day one.
Yes, and those funds for the protection of the association and the bank to make sure that it's used for the purpose intended would be placed into an account under the association with a hold. And the release form would be used every time that you need to pay the vendor. We would place those monies also in our ICS, Insured Cash Sweep, with access to full FDIC insurance to make sure that your monies in over $250,000 is fully protected with FDIC insurance.
Are there any, Rebecca, are there any restrictions on type of project? Or I know it's, as you well know, and you've been, talking with many clients about, the Sears components and, loans potentially to meet those requirements as well as the milestones. Is there any sort of restrictions that you have on projects where financing would not be available?
We haven't come across any of that. As long as they qualify financially and the useful life of the projects are within the terms of the loan, we haven't had any issues. We look at the accounts receivables, we look at the increase per unit, let's see, the loan to value, but the two major things that are looked at are the increase per unit. What impact does this new loan have on what you're already paying? What's the increase on what you're already paying? That's number one. And number two, of course, the percentage of past due units in their maintenance or any other special assessment.
Now, if you could just talk a moment, because some of the questions that I've been hearing out there is, from the line of credit to the term, and people get a little confused about what the collateral is. If you could
The
explain
collateral,
under
sure,
these
I can
types of
describe it.
loans, what the collateral is.
Yes, the collateral is the future cash flow of the association, meaning the general and the special assessment associated with your loan. We don't place liens on the individual units, and we don't ask for personal guarantees. In fact, in order to get this as collateral, what we do is we have it in security agreement and a UCC filing on the future cash flow of the association. And that only becomes into effect if the association, after several calls, several attempts to try to collect on the monthly association fee is not collected, then we would go to the courts and petition a receiver. Again, I've been in this industry for 25 years, and we've never had to go to the court to petition a receiver.
Now,
Okay.
also, that if you could talk about just in structuring the repayment, the association structuring the repayment of either the LC or the term loan, is it what type of vehicle can they go? Is it a special assessment? Do you want to see a special assessment for that purpose? Or do you want to see it part of operating budget?
It has to, it's typically a special assessment or a line item in the budget. We don't tell you how you're going to do it. That's really internal to the association. It is part of the language that we use in the documentation. We're going to give you a line to term, and it's up to you either if you're going to pass a special assessment or you'll have a line item in the budget.
Okay, so there's no restriction that has to be special assessment or has to be part of the budget.
And one thing I want to add, with other banks, before you close on a loan, they're going to require that you pass a special before you can close. With us, you can pass a special assessment at any time during the line of credit period, even if it's at maturity of the line of credit. But you just need to make sure, and we remind all the boards that they have to make sure that they have a line item or some source to be able to pay for the interest expense during the line of credit period.
Exactly. Now, which brings, going back to Reggie for a moment, one of the things that associations will face when they look to take this type of a vehicle, Reg, is cash flow. And, are they going to look at an assessment, or are they going to look at a potential line item in an operating budget? If you could just talk a second on how you work with boards in terms of working out cash flows, and what your advice is to boards when they start thinking about, well, should we do it via an assessment, or whether should we do it via a budget line item?
Sure, Doug. With regards to that, it's really boils down to the board too. The line of credit helps maintain their cash. That's the purpose of it, so they don't have to dip into reserves for that matter. Having the line of credit alone for the project, and using the assessment to pay back the line item, that is almost always the most popular vehicle for the boards to choose in order to help finance these projects, because again, the simple purpose is just to help them maintain their cash for other projects in case anything else comes up, because you just don't know what's going to happen. You can put the money aside to fix a problem, and then heaven forbid there's a hurricane that comes and you're really in a jam, or there's another emergency that comes. That's the beauty of having a line of credit to take care of these projects and for the funding.
Okay, great. Becca, let's talk about some of the new requirements that have come out. And one of the things is that we're getting a lot of questions of, is particularly with the new Sears requirements and the 100% financing. Do you offer any sort of vehicle, like a line of credit, that would help them comply with getting that reserve amount in order?
Of course. Yeah, we've done it all the time, and we'll continue. With more recent, we do offer the lines of credits for those larger projects. The project size are becoming huge. They used to be maybe 10 or 15 million, but they're looking more like doubling. And we do help with, in order for them to get the engineer report or the reserve study, we do help from the beginning to the end to fund whatever they need, their needs are. In fact, even for the reserves, we can have a line of credit for the new requirements on the reserves for the association to have a line to term, to meet the new requirements of having the reserves.
Is also, let's talk a little bit about interest rates. And I know, if we all had a crystal ball and we could tell where interest rates are going, we'd be doing that for a living. But can you give us an idea of what we're looking at currently that you're seeing
Yes.
out there for these LCs and the loans?
Yeah, the rates right now, I see them at 6.75 all the way to 7.25, depending. Rates are determined by many credit ratios. For example, the risk rating of the association, the depository relationship that the association is willing to maintain for the life of the loan, the interest rates on those deposits, the amount of the loan, the terms on the line, and the terms on the um, term loan. However, they are saying that because this is an election year, they are expecting that the Fed would reduce the interest rates 2 to 3 times. What I am telling all our clients, this is what the rates are, but we want to keep all our customers happy. So when rates go down substantially, maybe by 2%, that would be a good point in time where the association can come back to us and they can ask to refinance the loan. And of course, we want to keep them happy. As long as they refinance at market rates, we're not going to charge them the prepayment penalty yield maintenance. With that said, if you marry me today and you close the loan with me today and you decide to divorce me and go to another bank, of course I'm going to charge you a prepayment penalty fee of yield maintenance. But my goal, and I've been with this bank a long time and I'm the team leader for Florida, my goal is to work with our clients, keep them happy. And as long as we refinance with the current markets, everything should be fine.
Mhm.
And I've been in this situation before because in the 23 years, I started with very high rates in the 8s and the 9%.
Yeah.
And then rates went really, really low. And I refinanced lots and lots of loans. So we've been through this before and we'll just have to deal with it again. That's just part of life.
And one thing that Popular does that's really good also is prior to closing and once they're ready to move forward through the underwriting, they're able to offer up to 90-day rate guarantees when they're at the initial onset, 30, 60, 90 days. Of course, there might be a variance in the rate, but that is something that the associations have found very, very favorable as compared to, because when you're trying to get to closing and you have a 30-day window, Popular is much more flexible. They can go up to 90 days. Right, Rebecca?
Yes, and we'll also look at rates now that it looks like rates may come down. We will also look at the rates prior to closing to make sure that they are closing at whatever the market rate is at that point.
Oh, okay, that's definitely a positive there.
Absolutely.
Since these loans are, I use the term loan to refer both to the LC and the term loan, but more to the LC, because these vehicles or instruments are going to be used mostly for projects, which involve contractors, which involve construction contracts, which involves pay apps, the whole bit. If you could just go over, because one of the things that I get questioned all the time when I'm assisting one of our clients in planning these is we want to make sure that who's ever doing, we're in sync with the lender on the drawdown apparatus. Because one of the things that we want to make sure is that we're not obligating contractually the association to pay a contractor in a certain time period where if we're drawing down funds from a lending institution, they may not jive. So if you can just go through the procedure when a client is going to start to draw, what is it that you require and what is your review policy of that draw paperwork?
Okay, so when the closing is done and completed, the association will receive instructions on how to request a loan advance from the line of credit. The form, it's a form, it's called a line of credit advance form. That form is going to be pre-filled and it's going to have the purpose of the loan. It's very, very important that when you apply for the loan, that every single item that you are planning to pay from this line of credit is included in the project budget with an estimated cost. Okay. So that form plus the loan advance, and we also get a letter from the engineer or owner's rep who's going to sign the A1A form on behalf of the association. We get a letter with that person's signature. What we do is we verify in the system the two authorized board members that they are authorized to sign on behalf of the association. We look at the line, make sure that that all the conditions of the loan have been met, that there's available funds, that these two have authority to sign, the two board members. And we also compare the signature of the owner's rep, the engineer, or the project manager to make sure that it's correct. Once that is done, and that can take up to 3 days. If we can do it on the same day, we do it on the same day. But typically, it takes up to 3 days if we've received everything that we need. Again, it's a matter of how many are received per day. But typically, they do it within 3 days. We have a new manager in the division that wants to even shorten that a little bit. So we're looking from 1 to 3 days, but that's being worked on right now. Okay, and then the money is placed into the association's account, subtitle loan proceed account. And from there, the board member requests for the checks to be made payable to the vendor and sign the checks. That's how it works.
Great, so there's not a real extended period of time unless there's some sort of paperwork missing or something along.
that
It's not a
happens.
quick process.
And that happens. What I see the most happening is that a check is issued out to the association, but a request to advance hasn't been made. We make all the attempt not to return those checks. So what we do is we would reach out to AKAM and we would say, there's a check that was presented into the account, but it has caused an overdraft or an unavailable of funds. Are you planning on sending us the request? And if they say that they are planning on sending us the request and everything looks fine, then we go ahead and take care of it for the customer. Our goal is not to return any checks made payable to the vendors.
Now, you've mentioned before that you're seeing larger and larger projects in terms of dollar amount, with the Sears and the Milestone, and that's going to be with us for the foreseeable future. And I understand that some institutions are, when an application is made for an instrument, are having it reviewed before, as part of your due diligence, is having your own engineer look at the scope, look at the project. Is that happening across the board, or is that just selectively?
No, engineers are looking. The association's hired engineer. They're looking at the jobs, and we're making sure that everything that they have written in that report is being addressed. Prior to Champlain Towers, boards used to choose which projects to be completed and which could go ahead and wait another year or so. With us, we are making sure that every project that is listed in the engineer report that requires, because of a safety concern, we have to make sure that it's being addressed and funded with our loan.
Let's talk a moment about discretionary projects. Where an association wants to do hallways or wants to do a beautification project. Any differences on that, or would be the same process that they would go through for something that's, say, a mandated project?
Well, mandated, they have to do no matter what. If the board wants it or the engineer, if the engineer writes it, we have to, if we're going to give out a loan, we're going to give out a loan to make sure that everything that's mandated is taken care of. Now, the wish list, that's something different. That's up to the board, if they want to go ahead or not. But for the beautification, any alteration, material alteration, typically it requires a unit order vote. So there's a little additional steps that must be met before we can close on that loan.
Okay, so that means making sure that everything was done in statute, material alteration, approvals. If the docs require a membership approval of amounts or anything like that, you're checking to make sure that everything's obviously in compliance.
That's typically really managed by the association's council before they render their opinion letter. The opinion letter is to say that the board has the authority to go ahead and enter into an agreement on a loan, that they check the bylaws to make sure, what is requirement, if a unit owner vote is required or not, to either entertain a loan and or to pass a special assessment and the amounts. But that's typically more of association's council, and it's required by the bank for the opinion letter.
Mhm. What do you see? Do you see anything on the horizon that you've heard, in terms of these financing vehicles, that any new products that are going to be coming out or thought about in answer to some of the new regulations?
I hear, but there are rumors, I haven't really checked on them, that the government may be coming up with some type of funding to help associations. But I really don't know the details of that. I mean, I'm getting 6, 7, 8 applications per day for loans, and they are monster loans. I mean, I've never seen anything like it, and they're complicated. They're complicated because we need to make sure that everything is done according to the bylaws and how it's supposed to be done.
In terms of an association getting their council involved, when do you recommend that happens? I know that they'll get involved when term sheets and all of that, but pre that, before they go to a bank, is there any, constructive thing you can give about when to start working with your association council?
Well, all boards should know before going to a bank if they have the authority to borrow money. If a unit owner, what type of vote is needed by the community, what steps they have to take. They have to look at the bylaws. So that's not a bad thing to look at and address with your attorney. But definitely when we issue a commitment letter, and before they sign the commitment letter, I see many associations that go ahead and review it with their attorney prior to signing the commitment letter.
Right, absolutely. And I know there's some back and forth typically with language or whatever, but you guys, I know, have been one of the best in terms of working that out, in getting that done. The other thing that we want to take a look at for a moment is, I know you mentioned that the proceeds are held in, and if you could just talk about, because it's something that boards always worry about, is their money safe? And you mentioned that, you're using FDIC insured. So if you could just talk a little bit more about that when you're dealing with proceeds and when you're dealing with funding.
Yes, any account. Okay, so the access to the FDIC insurance with our bank is available for your regular checking accounts and for all savings account. In other words, it's available for all your accounts, and it's fully FDIC insurance. It's called Insured Cash Sweep. And it's and I can send you information to pass along to your boards in regards to the Insured Cash Sweep information, how it works. It's a network of banks where we go ahead and we deposit it 240, 230 in each of these banks that are in the network. And if you don't like any of these banks, or you have deposits already in this bank, you must tell us so we don't place the monies there. Because remember, associations have one tax ID number, and the banks can guarantee the FDIC up to $250. We like to do 230, 240. Why? Because we want to make sure that we cover your your interest as well, principal and your interest on your monies. So anything in excess of that, what we do is we sweep it over to the network of banks where all these banks are members. And if you don't like any bank for any reason, I've had associations, nothing against Chinese, but I've had associations come to me and say, don't place my money on the Bank of China. Okay, not a problem. Within 24 hours, that money is taken away from that bank and placed into another bank that's part of the network. So that's how it works. And we also have, that would be liquid funds, but we also have certificate of deposits, which in this network, it's called CEDARS, and it provides the FDIC insurance for anything above the 250.
Okay, so boards can be rest assured that they're going to be within that safety net. Obviously.
Absolutely. And they should look at it now. They should look where they have their monies now. They're very safe with us because we provide the FDIC insurance. But with everything that's happened lately or through the years, check where your money's at and make sure that you have it in a product that's going to give you 100% FDIC insurance, because they do have a responsibility with the rest of the community.
Mm-hmm. Now, one of the things you brought where we're talking about accounts, and because I know a lot of the lenders out there, they will have, as a condition of the loan, they will have accounts that may have to be kept at the bank that the loan is with. If you could just address that, and is popular among those.
Yes, of course. If we're going to be your lender, we also want to be your deposit bank. So we're going to ask you what depository relationship you feel comfortable in maintaining for the life of the loan. Because what happens is deposits. That's what the banks are after. And they do buy the interest rates on your loan. So if you're going to have monies at ABC Bank, but we are going to provide you with a loan, why have the monies in ABC when we're going to help you out with the loan? Bring the monies over and we'll help you reduce the interest rate on your loans.
Great.
Now that money is not going to have a hold. That's a depository relationship. So we look at the monthly average deposit. If there's an emergency and you don't have a contingency line of credit, which we also offer contingency revolving lines of credit for emergency purposes. If you don't have one and you have a loan with us and you have committed contractual deposits for that loan, you have an emergency. It doesn't mean that we're not going to allow you to use your monies. You can use your monies, but in good faith, remember that you agreed to keep X number of deposits to buy down those rates on your loans. So it's a two-way street. We work together with our client, and if they see that they're running into some trouble with their cash flow, we could also help them with contingency revolving lines of credit that is available.
Oh, okay. So that can also be offered to the association. Oh, okay.
Absolutely. And if it's closed at the same time that you close on the regular loan, we do it as a master note with 2 tranches, and it helps on all the closing fees. See, for example, the Florida documentary stamps is per note. There's a maximum of $2,450 on the doc stamps. If you take a master note with 2 tranches, one for the regular line to take care of projects and a line for emergency purposes, we do it under a master note. Please don't say my secret to the other bankers. I do it under a master, and we only charge you for the closing fees, including the doc stamps for 1 note.
Ah, okay. So it's basically combined for the doc stamp purposes. Okay, great.
That's correct.
Great. Because I think a lot of associations now are looking at that as a possible and we all have been hit with the incredible insurance increases.
Yes. And for insurance, we also have a revolving line of credit for the purposes of funding the insurance. And with us, the rate sometimes is a little higher, but you only pay the doc stamps on year 1, and going forward on any renewal time, you would only pay the doc stamps on the increase in premium amount. And we try to give you the market rates on that as well. We do those lines for 3 years.
Could you talk about that process a little bit? Because I think that's something that's been in everybody's minds, particularly, you know, when they've recently, you know, passed budgets and everything, is they're getting 40, 50, 60, even as high as 100% increase in their premiums. If you could just delve into that.
Or 3 times.
Yeah.
Or 3 times. We're seeing it. We're seeing it. We had a meeting because we're so concerned with that. We had a meeting last week. We called in one of our partners, Brown and Brown, and he gave us a analysis format that they are using the past, what's happened for the last 250 years. And this is something that you may want to ask, you know, your insurance partners what they're using now, because the insurance cost is so much nowadays that it's very difficult. First of all, it's difficult to be permitted to be insured. Some associations cannot even get insurance. And then the other problem is that they get insurance, but they don't get 100% insurance.
Sure.
Or they get insurance with limits. So the insurance industry right now, what's happening with the insurance, it's really very difficult. It's very bad what's happening. And we're trying ourselves to understand what we can do to help the customers, what we can do to help the associations. We have associations right now that cannot get insurance until they fix their roofs. Well, typically, you cannot get a loan if you don't have insurance. So we are working with our insurance partners to see what kind of product we can have available for those associations that cannot get insurance because they have to get the roofs done. But what do they do in the meantime? So those are all the things, because we specialize in providing funds and banking products to community associations. We are very active out there trying to find solutions with all the changes and everything that's happening with the insurance industry and everything else that's happening with the reserves and the large projects and so forth. And we're working on that very diligently.
Yeah, that's going to be.
I wish I had answers for you today, Doug, but we're in the midst of that. We just met with one of the insurance agents, but I look forward to getting more information so I can share with the associations out there.
No, that would be definitely, because that's on everybody's mind. And that combined, as we're talking about with the projects, the required projects are just putting so much pressure on associations and their membership. So anything that can be, you know, anything that can be helpful from the financial end would definitely go a long way to helping the associations. We had
and I'm looking into that. And you know, as soon as I have answers, I will make sure to share with my friends at AKAM.
Right, we appreciate it, absolutely. We had a question in the Q&A, and you know, we're talking about Reggie's involvement in the process. And for our AKAM clients, Reggie's services in terms of going out and talking with banks and getting term sheets and everything along those lines, that's included in our clients' management fees. There is no direct charge for Reggie's involvement on that. That's just a service we offer under the cash management umbrella here.
Correct.
At this point, Rebecca and Reggie, if you have any closing comments or anything that you talk about associations to really look out for in this coming times. I mean, we're towards the end of the legislative session. We've heard a bunch of rumors about, is things going to be extended? Are there going to be new requirements or anything? So I think that is obviously something that will be for a further webinar. But just out there, if you could give just a one last comment on how associations should really place themselves in when they're looking to finance these projects.
Do you want me to start, Reggie, or are you going to start?
I'll say I'll say something quick. Okay. Doug and I have spoken about this as well too. But you can never start too soon. You can never start too early. Preventive maintenance is really the best. Be preemptive with with the needs of the association, and don't look to just piecemeal the projects together. Really look to just get it all done in a comprehensive manner. And a bank like Popular will be they're very flexible in their terms and their rates and their loan structures to accommodate just about every single need. So look at a comprehensive solution now, because it's with the upcoming regulations coming up, it can only get more complicated. So don't put off any work that needs to be done on the association.
I want to add with that, make sure that you do not wait around. Engineers are very difficult to find nowadays because
Exactly.
everybody at the last minute,
That's
they're going to call the engineer, they're going to call their accountant, their attorney.
that's
Be active now. Be active as quickly as possible. Get that information. Find out what needs to be done in those buildings, and then we can work together to help you fund those projects. But be active on that, because engineers are very hard to find. Owners reps are very difficult to find. So I would be very active in that. It's my message to you today, this afternoon.
We have one final question in the Q&A that I wanted to bring up before, and I did not. But does Popular Bank, and I know other institutions do as well, aside from the engineer, when you're talking about financing these large projects, do you require any other oversight that the association needs to retain, like an owner's rep or a project manager?
We don't require it, but we suggest that it's a good thing to have a project manager or an owner's rep. We're talking about very large projects. And although your property manager may know and may be able to assist, they have a building to manage. And these are big, very large projects. We strongly recommend that you get an engineer, a property manager, owner's rep to look at these and supervise your buildings while these projects are being done. Not only for you, but for the bank that we're lending you the money.
Great, thank you. I think we've covered a lot of topic here, and I think one of the things that we can do as a takeaway is, number one, we'll move on so that everybody can get on the screen everybody's contact information, Rebecca's, Reggie's, myself's. One of the things, this is going to be an evolving landscape out there. I mean, I think we're going to be seeing different regulations. We may be seeing some amendments to existing regulations. But I think if the thing that we can take away, or associations can take away, is be prepared and don't wait. Start now in your planning. Don't wait till the last minute, till a week before a report is due, or an answer to a municipality is due. It's only going to get much harder with the amount of associations out there and the resources, both with engineers and even banking. I mean, it's just not an infinite well out there. It's going to be tightening up. So I want to thank both Reggie and Rebecca. You've some great takeaways. I hope all our viewers were able to glean some information off of this that will be helpful in your planning and your association. And as I say, our contact information is on the screen. For those attending the webinar, we will be sending it out to you in a little while, because it is being recorded, and we will send it out to our registered participants. So again, thank you for participating. And Reggie, Rebecca, as always, it's a pleasure speaking with you. And thank you for your unique insight.